So welcome to Chapter 10. So as I stated in Chapter 9 video, I'm going to start doing the videos and showing you the homework. So you can see the questions. They may not come in the same order for you, or you might not have the same choices. But the best thing I can suggest is clicking the e-text pages, and that will bring up the chapter. So then you can peruse the chapter and try to find the answers to the questions. That's the best way I can share with you. So this first question is about steps in buying a home, purchasing a home. So again, use the e-text pages for that. Affordable payments. What should you consider? Again, click the e-text that's in the chapter. How do price, convenience of the location, and maintenance affect your home buying decisions? So again, that would be in the e-text, how they spell that out in this chapter. School system influence. Why is the reputation of the school system in your area of the home you are buying important? So again, you just want to go with your best choice. Again, I would click the e-text because it could be something that you think, but that's not what was discussed in the chapter. So if you want to get it right, again, I would click the e-text and actually look for these answers in the chapter. Same thing with market analysis, fixed rate mortgage. They offer fixed rate of interest for what? An amortizations table, that's going to show you basically like your interest and your payment, all that stuff, and like what you're going to end up paying over the life of the loan. Adjustable rate mortgage, again, click the e-text. It's going to tell you like what the best choice to fit this question. Costs of renting. Now again, renting is not horrible, but again, it's not yours, so it's not an investment. When you can buy a home, it's an investment opportunity for you. So if you did have to sell, you probably would make a pretty decent profit. So what costs go into renting a home? And again, if you don't remember reading it, go back to the e-text and find this section in the chapter. This talks about refinancing, same thing. Here's some of the math. So it says Dorothy and Matt are ready to purchase their first home. Their current monthly cash inflows are $4,600, and their current monthly cash outflows are $3,661. Their rent makes up $598 of this outflows right here within that $3,661. They would like to put 10% of their cash inflows in savings and put another $184 per month in their checking account for emergencies. How much of a mortgage payment can they manage under these conditions? So this is what they want to show you. So their inflows are $4,600. If we take that and multiply it by 10%, they should be putting in $416 of their savings. So if we take that $3,661 minus the $598, because again it said the $598 was included in their outflows, add that $460, and then add that $184 that they want to put into their checking for emergencies, they're now at $3,707. So the amount of cash flows that they would expect to have after adjustments are made for rent, savings, and emergencies. Therefore, to calculate the mortgage payment they can manage, use the following formula. You would take the inflows, which is $4,600, minus what we calculated here, the adjusted outflows, and that gives you $893. So they can manage a mortgage payment of $893. So that's how you're going to do this particular question, math related. This one, Denise and Kenny are ready to make an offer on a 2,200 square foot home that is priced at $148,300. They investigate other homes on lots of similar size and find the following information. So if you look at this information, what offer should they make on the home? So again, looking at this with my numbers, add up the selling prices of all three homes, and if you look at my formula, I'm going to take that number and then divide it by the total square footage. So then you're going to add up the square footage of all three properties, or four, how many you're going to have, and divide by that, and this is telling you how much a square foot. So then the average price per square foot would be $63.56. So to calculate then what they should offer on that 2,200 square foot home, take $63.56 times 2,200, and this is what they should offer. Now, would they accept it? I don't know, but that's how we would calculate for this particular question. The next one is closing costs. When you get this, like again, yours may not be in the same order, but Larry and Lori have found a home and made $143,800 off of it. Has been accepted. They make a down payment of 10%. Their bank charges a loan origination fee of 0.6%. That's not 60%, it's 0.6% of the loan and points of 1.3%. Both are based on the loan amount. Other fees include a $40 loan application fee, a $220 appraisal fee, and $340 for title search and insurance. How much cash will Lori need at closing? Hint, the loan origination fee and points are not part of the loan and will be needed at closing. So that means those two are added at closing. So we're going to take the down payment times 10%. So they're going to have to definitely have $14,380. Then when we take the mortgage money, that this is what they're borrowing. So this is the value of the mortgage, $129,420. Again, you're going to have different numbers. So to calculate the points, we're going to use that $129,420 times 0.013. Gives you $1,062.46. Again, you're going to have different numbers. So that's the amount of the points. Then the loan origination fee, remember, it was 0.6%. Well, if you were to put that in decimal, or you just moved your decimal 2 places to the left, so take that $129,420 times 0.006. Their origination fee is $776.52. So now we're going to calculate the amount needed for closing. So we're going to take that $14,380, the down payment, plus the points, $1,682.46, plus the origination fee of $776.52, $40 for the application fee, the $220 for the appraisal, and the $340 for the title. When you add them all up, this is what they're going to need to bring to closing: $17,438.98. So again, buying a home is great for an investment opportunity, but there are other costs to it. So this one, when we calculate the total interest paid, I have Lloyd and Jean are considering purchasing a home requiring a $102,000 mortgage. The payment on a 30-year mortgage for this amount is $664.96. The payment for a 15-year maturity is $905.44. What is the difference in the total interest paid between the two different maturities? So again, we're just going to look at it like this. Remember, they're going to take that out for 30 years, so you want to take that monthly payment times 360, because 30 times 12 gives you 360 payments. This is what they're going to pay back at the life of the loan, which is more than what you took out, but hey, maybe this is affordable for you. Then you want to take that minus 102,000. Again, your numbers will be different than mine. So $137,385.60 is the difference. Now here's the 15-year. So 15 times 12 is 180. Take that higher payment times 180. This will be what they will pay back the life of the loan. Take that amount minus 102,000. You have $60,979.20. So we're just going to take this amount for the 30-year mortgage and then the 15-year mortgage, subtract, and the difference is the total interest paid, $76,406.40. So again, you would have different numbers than me, but that's how you're going to calculate that one. This one is the month. This month you made a mortgage payment of $680, of which $456 was in interest and $224 is for principal. You are in the 32% marginal tax bracket, and you will itemize instead of taking standard deduction. What are the tax savings? So this is what you'll do. You want to take 456 times 0.32 gives you $145.97. So whatever you have on your screen, this amount times whatever your marginal tax rate is. Next one is cost of a condo. So he's going to need $58 down payment from a savings and would have to pay closing costs of $3,091 to purchase a condo. His monthly mortgage payment would be $630, including property taxes and insurance. They have a homeowners association charge maintenance fee of $474 per year. Calculate the cost of his condo in the first year if he has to put $5,800 down. So you want to take the 630 times 12. So for year one, $7,560 for the payments. The down payment was $5,800. If you take that, $5,800 times 6% was $348. Property taxes, they told you in the question, and the maintenance. Add them all together, and you get $17,273. So you just got to break it down. This one is he's paid mortgage interest of $5,430 during his first year in the condo. His property taxes are $711, and his homeowner's insurance was $539. If Matt is in the 10% marginal tax bracket, what were his tax savings? So you just want to take the $5,430 plus $711, you get $6,141 times 10%. So your answer would be $614.10, but again, you would have different numbers than me. This is refinancing. The cost of the refinancing the house is $2,980. How long would Doug and Lynn have to remain in their home in order to recover the cost based on the annual savings of $996? Ignore any interest on the savings in this question. So you want to take the cost of the refinancing, which is $2,980, and then divide by the annual savings, which was $996 from my problem. It would be 3 years. So again, you take this, divide by that. So whatever your numbers is your problem. That's what you're going to do. Mortgage affordability. Paul will be able to save $182 per month, which can be used for mortgage payments for the indefinite future. If Paul finances the remaining cost of a $76,000 home after making $15,200 down payment, amount to finance $60,800 at the rate of 4% over 30 years. What are his resulting monthly mortgage payments? So this is where you want to take the $76,000 minus $15,200. We know this is what he's financing. $60,800. Take that monthly interest rate, divide by 12. So in this case, 4% divided by 12.333, and then go to that finance calculator. So we know the N, number of payments for 30 years, 360. Interest would be when you do your division. Present value would be what you're borrowing. So like my case, it's $60,800. 0 for future value, and it's going to give you the monthly payment. And that's that. So good luck. Again, use any help to solve this or e-text. Good luck.